Stocks trade in a narrow band as the recent Trump messaging alleviates uncertainty. Financials and FMCG eke out some gains, while IT and metals drag in trade. Mid-caps are better placed.
IndusInd Bank could see the exit of 3 senior executives, including the CEO, the deputy CEO, over delayed reporting of the discrepancies in derivatives accounting. Sources tell CNBC-TV18 this, even as auditors put the financial impact of irregularities at 1979 crores, less than the earlier estimated sum.
A revision in the administered gas allocation to city gas distributors involving a reduction in the supply from old fields and some allocation from new blocks is seen driving up costs. Stocks of IGL and MGL slip on the revision.
The union government is expected to float a tender for 10,000 e-buses next month under the PM's e-drive scheme. State arm CESL will also issue a tender to select city e-bus operators for 9 cities.
SEBI outs Gensol promoters from key positions in the company and bars them from the market after it discovers incidents of fraud, stock manipulation, and fund diversion for personal users, like booking an apartment in Camellias and buying golf gear.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me today is Nigel D'Souza. So the team of Chartbusters comes to you for Halftime Report as well. In the last hour or so since we left from Chartbusters, what is it that has changed, Nigel? We come to you live from the CNBC-TV18 Motilal Oswal studio. The frontline indices more or less consolidating. It's the mid-caps which are doing a lot better. The Nifty Bank even more so. The only difference during Chartbusters, we had the Nifty and Sensex marginally in the red. Now they are marginally in the green. The mid-caps and the Nifty Bank, which is basically above Nigel's head, continues to do extremely well. So, good afternoon so far, Nigel, notwithstanding the consolidation that we're seeing in the front end of things. And that's largely understandable because of the volatility that we saw earlier.
Well, that's right, Mangalam. If you put it in context, the US futures are down. The Asian markets, most of them as well, are trading with a bit of a negative tick. And in this sort of a backdrop, the Nifty actually is holding flattish with a bit of a positive bias, with the Nifty Bank the one that's powering its way ahead. So that's good news, and the breadth of the market as well is firmly in favor of the number of stocks that are advancing. 3 stocks advancing for 1 stock that's declining. Just take a look at the Nifty Bank. Now the Nifty Bank is less than 3.5% away from a fresh all-time high. Talking about banks, well, let's talk about IndusInd Bank. It's surging in trade after the company reported external audit has found 1,979 crore rupee reduction in the bank's network. That's due to the derivative discrepancies. Ritu joins in to fill us in with that and also what brokerages are making of that. Ritu?
Well, a top-level shakeup could be on the cards at IndusInd Bank, with sources indicating at least 3 senior-level exits expected in the coming few months. Now, we've been given to understand that the CEO, along with the deputy CEO who is in charge of global markets, including the derivatives portfolio, are among the 3 executives that could be asked to step down because the regulator has expressed displeasure at the manner in which the entire issue was handled and the delay in disclosures. Now, while the board is already working on the CEO succession plan, we've also been given to understand that the regulator has asked the bank to submit the shortlisted candidates at least 4 to 6 months before the current CEO, Sumant Katpalia's term ends in March next year. However, in its response to our story, the bank has denied receiving any such communication and did not comment on the management changes. Now, the bank has also received the external auditor PwC's report on the derivatives portfolio, which pegs the hit at 1,979 crores, which is broadly in line with the management's estimates as well as the street expectations. And we understand also around the regulator's preliminary assessment of the hit. Now, the bank had first pegged the adverse impact at 2.35% of its December net worth, which it has now revised down to 2.27% on a post-tax basis and will reflect it in its FY25 financials. So no nasty surprises on the financial front. Brokerages like Morgan Stanley say they will closely monitor the upcoming earnings for insights into the outlook on margin, growth and asset quality. Macquarie sees this as incrementally positive in the near term, while Citi says developments around the CEO transition will be closely monitored.
Thanks a lot for that. Ritu explains why the stock after yesterday moving up, the street has read this positively. It's up another 6% as we speak. But let's get in some opinion that we got earlier today. Steel Secretary Sandeep Pondrik tells CNBC TV18 that the safeguard duty recommendations are under examination and a decision is expected in the near future. He adds that it is difficult to say if the rate will be revised from 12% to around 20%. He also mentions there is no mega merger between the steel PSUs. Let's listen in to excerpts of that exclusive conversation.
DGTR has recommended 12% safeguard duty on certain products and with caps on prices of those products. That recommendation is under examination in the government. I think in very near future a final decision will be taken on that. On your second point about 20%, I really don't know because it's as you know, the DGTR process, the safeguard duty imposition process, is a sort of a quasi-judicial process, and DGTR has heard everyone, asked for objections, and after that they have recommended this safeguard duty. I don't see any reason for the rumors about 20% safeguard duty. The per capita consumption in the country now is more than 100 kgs per person, and it has been seen with respect to other countries that when a country goes at this level of 100 kgs per capita consumption, then the elasticity with respect to GDP growth rate increases. So till now it is 1.2, 1.4. Now I expect that the elasticity will be more than 1.5. So even if with that, if you see our GDP growth rate around 6.5 or so, then the steel consumption should grow about 10%. RINL, as you know, that government has given a lot of money to RINL to keep it as an ongoing concern. So I don't see any possibility of immediate merger. That decision is not there in the government. Similarly for NSL, so for now, no such talks are, or no such thing is happening in the ministry for merger of these three. As you know that the 21 decision of cabinet that NSL will be divested still stands. However, not much progress has taken place on that front.
All right, with that, we'll slip into a short break. And as we do that, here is some good news for our viewers. India's business news leader, now just a click away, which is the CNBC-TV18 All-New app. You can get instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. You can download the app from the Apple Store, the Google Play Store, or just scan the QR code, which is there for you on the screen. Welcome back. You're watching us here on Halftime Report. Just keep an eye out on United Breweries. Remember, the stock was doing well in yesterday's trading session. Right now, we've got an update for the January to March quarter, and this has been published by Heineken NV, basically, which is the promoter of the company, along with their results. What they've said is that in India, the net organic revenue has grown in low teens as beer volume grew by mid-single digits. So that's the number to watch out for. Low teens revenue growth, beer volume grew by mid-single digit. And the stock should see some decline because they said that their growth was lower than the market because of supply disruption in one of their major states. Remember, we had the Telangana issue for, United Breweries when it came to them actually stopping supplies there. And thereafter it was fixed. It was temporarily halted due to ensure sustainable business model for the future. As a market leader, they continue to actively unlock premium segment, etc., which grew in the 20s, led by Heineken Silver, Kingfisher Ultra and Kingfisher Ultra Max. So short point, mid-single digit volume growth for this entire quarter, lower because of a temporary impact in Telangana. The premium part of the business growing in 20s itself when it comes to the volume. So just keep an eye out on United Breweries. But let's move on. Let's talk about ICICI Lombard. It's recovered from its opening lows, reacting to its fourth quarter earnings. Earlier today, we spoke with the management on their Q4 performance and their outlook. But before that, Yash joins in to give us earnings insights in our special Insight Edge segment. Yash.
Well, Mangalam, let's look at both aspects. A, what does the result for the fourth quarter look like, and why the stock is still under pressure, though it's recovered from the lows, but why is it still under pressure? As far as results for the fourth quarter are concerned, they seem strong. The net earned premium, that has grown at 20%, which is a healthy rate, at about 5,226 crore. Underwriting loss has reduced by 11%, coming in at about a loss of about 210 crore rupees. The operating profit, that is down 26%, but that is largely because of the investment income also being lower to the same proportion in the fourth quarter. The combined ratio has been well protected at 102.5 versus 102.3. Now, the PAT is down about 2% in the quarter. Why the stock is under pressure? That is because uncertainty on two things. One is how will the motor business turn out in the coming financial year, that is FY26, with sales seeing some pressure, especially the two-wheeler sales in the rural pockets of the country. How will that pan out for the motor insurance business of ICICI Lombard? B, the entire insurance sector has been trying for a pricing revision when it comes to motor third-party premium prices, which are in the hands of the regulator. No luck so far for about a few years now. The industry is hopeful that something will transpire in FY26, though the management clarifying to us that there has been no communication whatsoever, no hint whatsoever of any pricing revision in this year as well so far. So that also plays as far as the uncertainty point is concerned. If there is no price revision, it would adversely impact the motor portfolio, increasing the loss ratios, and that creates a fair bit of uncertainty and negative uncertainty as far as that particular stock is concerned.
All right, Yash, thanks a lot for that. Let's also hear out what the management had to say to us.
Across different segments, I think the road that's kind of laid down looks very, very promising. Whether you look at the infrastructure investments and logistics coming in on the commercial lines, pricing uptick again happening in that segment, health looking quite promising, continuing to look to exhibit a double-digit growth, and even motor, I think in terms of how do we see things playing out in the subsequent year, looks promising. So all in all, I think what we would kind of continue to pencil in is to outperform the industry in that range of, as we keep saying, between 200 to 200 basis points insofar as top line is concerned, and obviously a trajectory to see an improvement in combined. See, what we've been able to deliver is a consistent improvement in combined year on year. That's what we had kind of spoken about as well. And even in fact, at the beginning of the year, honestly, if you look at in our April 24 earnings call, we did kind of expect the market to be slightly more semblance insofar as combined ratios are concerned. But if you look at the 9-month numbers, the industry has actually seen an adverse development in the overall combined. In fact, it has kind of moved by about 100 basis points from 112% the previous year 9 months. So the key thing to watch out for is what direction does the market take? And in that context is how we will be kind of positioning our opportunities. But everything remaining the same, definitely we would want to see an improvement in the combined going ahead. And more importantly, as I said, the return on equity range that we want to continue to start exhibiting to the stakeholders will be within that 18 to 20%.
All right. Well, Yash is still with us. Yash, tell us about ICICI Prudential. That's the other stock that's reacting to its quarter four numbers.
Well, ICICI Prudential Life Insurance is reacting positively to the numbers, and of course, important reasons for that as well. On one hand, the disappointment has come on the top line, that there has been fair bit of sluggishness when it comes to the top line growth, the premium growth. What has worked for the stock today are two things. One is how the company's managed to hold on or in fact improve its margin performance in the quarter. Second thing is with respect to the positioning of the stock as well. Let's look at the numbers a little more closely. New business premium, that has grown at about 14%. Total APE, that is down 3%. It's missed CNBC-TV18 poll as well. Retail APE is down 2%. Now, this is the sluggishness that I've been speaking about as far as the top line growth is concerned. Let's look at the margins. The margins have improved by 120 basis points. The margins have come at about 22.7% versus 21.5% on a year-on-year basis. Against the poll also, there's been a fair bit of beat which has come on the margins at 22.7% versus poll of 21.8%. This is the first factor which has worked for how the stock is reacting today. The second thing, as I said, positioning. It's not the most expensive stock in the list of life insurance companies. Also, the stock is down 14% in the last 3 months. So, of course, taking respite from how the company managed its margin performance, though the premium growth has been slow, and positioning working for the stock today.
All right, Yash, thanks a lot for that. So that's about ICICI Prudential up nearly 3%. We take a short break. On the other side, Pritesh Mehta of PVR Securities joins in with some trading strategies.
The ghost of 2008, which gives
never
us all
leaves
that,
you. It
would
never
never
leaves
leave
you.
you. So far, it's been moving along as Trump had planned.
Yeah.
And I think the worst is behind as far as the markets are concerned.
I remember doing a show when Zomato was listing with some of your team members. So I took early calls.
This is one of the lessons I learned, I would say, early in the TMT bubble, .com bubble. In my US portfolio, I never could buy Amazon,
Okay.
thinking that it's not making money. And at that time, it was also an assessment that it can never make money. Today, I often get asked, because we are very cash flow centric and there are loss making companies in our portfolio as well. Value of any business is present value of future cash flows. It's not necessary you have to make cash flows in year 1,
Yeah.
year 2,
Yeah.
or even year 3.
Is the post-COVID era dream run of 3, 4, 5 years?
Certainly.
Is that over?
Post-COVID 5-year fantasy run is over. A dream run, I would call, is much longer term.
Welcome back. Well, markets are holding with some gains. A couple of stocks have moved to the high point of the day. IDFC First Bank, they'll be considering a preference allotment. So that stock now has moved to the high point of the day. Lloyd's Engineering, that's the other company that's going to be considering a rights issue. So that as well has moved to the high point of the day. It's recovered from the recent lows out there. So we'll have to keep an eye out on that one as well. That should come up for you on the screen. But let's focus on a clutch of stocks that are not doing too well. City gas distributors are under pressure after the APM gas allocation was cut by 18% effective today. Sid's with us to fill us in with those details. Sid?
So 2 weeks and 2 negative news flows related to city gas companies. On April 1st, we saw that APM gas price was increased to $6.75 per MMBTU from $6.50 per MMBTU. While that was on expected lines and it was announced as per the recommendations made by Kirit Parikh panel in 2023. But now this APM gas allocation cut has come as a surprise for city gas companies. And in the last 1 year, APM gas allocation has been reduced by almost 50%. In the beginning of 2024, the gas allocation used to be in the range of 70 to 80%. Now, after this cut of 18 to 20%, the gas allocation for city gas companies is reduced to 40%. So MGL says this might have an impact on profitability. Same comment is made by Adani Total and IGL as well. CLSA believes that these companies, especially IGL and MGL, might have to take a price increase that might be less than ₹1 to pass on this cut in APM gas price. While Jefferies believe that it won't be that easy for city gas companies to pass on the APM gas cut. Also, it builds in flat EPS estimates over FY 25-27. But the question is the cut done, or there might be a further APM gas allocation cut we might see in the future?
Take that point entirely, Sudarshan. What we'll do is take a short break on that note and come back the promised conversation with Pritesh Mehta of PVR Securities with some trading strategies. Welcome back. Just look at the market right now. We have the Nifty virtually unchanged from the time when we started the show, but still marginally in the green. We have the Nifty and the Nifty Bank and the mid caps doing a lot better. So perfect time to get you an F&O update during the middle of the day. We have the frontline indices, which show a strong outperformance of the Nifty Bank, which is above all moving averages right now as well. And the mid cap index doing a lot better, with advances far outnumbering the declines by a factor of nearly 3. So you have 1,900 stocks which are in the green for about 650 which are in the red as well. Because the Nifty bank is outperforming, it is understandable that among the top gainers we will have the banking names. IndusInd and Axis are the ones that really stand out. IndusInd for this week itself has completed a gain of almost 12.5%. Was up in yesterday's session too. Now there is a travel and hospitality summit which is underway, so the street believes that maybe there could be some announcement that would come by, which explains why these stocks have been buzzing around over the last couple of days. So we have Sami Hotels up 9%, we have Yatra Online, Travel News Techs, which is basically Ixigo, and Park Hotels, all of them putting in some gains after the decline that we've seen in these names earlier as well. The Nifty is above the 20 and the 50-day moving average, which it conquered yesterday. The question is whether it goes past the 100-day moving average or not, which is at 23,391. All of that depends on what happens tomorrow. Why? Because tomorrow is a Thursday. It is the weekly options expiry, and we're close to the 23,350 mark on the Nifty, but we are seeing action at both the 23,300 call and the 23,300 put. You put the options in this together, it makes it around 150 rupees, telling you that the street is positioning itself for 23,150 at the lower level to 23,450 at the higher level from an options expiry standpoint in tomorrow's trading session itself. Individual stocks, IREDA is fairly well built up in today's trading session, but it may enter F&O ban given the sort of open interest built up and that having crossed that 95% mark as well. So that's one stock I'll keep on my radar.
Okay, all right, Mangalam, thanks for that. Well, let's get in Pritesh Mehta, Executive Vice President, Yes Securities, who joins us on the show. Hi, Pritesh. A good-looking screen, right? You'll say 15 points. What are you talking about good-looking? Well, I'm talking about it in the backdrop of what we're seeing in Asia, the US futures as well. So 15 points up is not too bad. What's your guess? We're going to be testing higher levels. I think, the next resistance will come in around the 23,850, which was the recent high that we made. But how do you trade it in the near term?
As we speak, India is trading around the levels of 16 mark. It was down 20% yesterday. It means that the extreme fear that we have seen last couple of days, that has collapsed. It's a good news. And when we look at Nifty, it has defended the low of the month of March on closing basis. And thereafter we've seen a sharp recovery. Also, our customer stock and Nifty is moving higher from support zone. The breadth is improving. There is more participation, from the broader markets, from the Nifty as well. There are around 55-56% of Nifty stocks trading on 50 moving average. So I think the things are now smoothening. We are done with the kind of rocky start that we had, to the month of April. But from here on, I think markets will consume time. The right way to play this market would be focusing more on stocks. Index, I'm not expecting any move either side. In fact, we can see range bound movement continuing at least for the next couple of days. But focusing on stock specific activity would be the right way to play this market.
Okay, then why don't you give us some stock specific action, Pritesh?
Yeah. So Nifty PSU Bank Index is up by 2% today. So when I look at the entire basket, there are several components which are providing short-term reversals. But Bob, Bank of Baroda has caught our attention. In fact, if you look at the ratio of Bob versus PSU Bank Index, it is trying to come out of a 4-month base. So we can see sharp outperformance from Bank of Baroda in the next couple of weeks. And on standalone chart, we have seen series of bullish anchor columns and follow-through moves coming in. So buy Bob for a target of 275 and stop loss would be around 224. The second stock that we like is Shree Cement. Now see, our customer cement index is trying to break the previous peak seen in 2024. It is improving. The structure is improving. And when we look at Shree Cement versus the customer cement index, it is outperforming. So even on standalone chart, we can see the stock trying to surpass the peak of 2021. So big base breakout is in the offing for this particular counter. So buy for a target of 35,000. The stop loss would be around 29,000.
All right, we're looking at a couple of these consumer names as well, Pritesh. I wonder whether you have a call on them. Tata Consumers moved to the high point of trade for the last couple of trading sessions. Asian Paints seems to be doing well. This is the season for them. At the same time, crude oil prices are contained. Berger Paints, as we speak, is up around 3% as well. And then yesterday came the comment of, a normal monsoon or above normal monsoon from the Met authorities. On the charts, is there any FMCG stock that you like?
See, when you look at the overall trend of FMCG space, they have been laggard. They have underperformed vis-a-vis index. So when we look at something like Dabur, it has caught our attention. The stock is trading at around 10-year mean. The stock has not done anything last couple of months now. Now it's trying to recover. We can see some stability coming in. As far as Asian Paints is concerned, yes, it is bouncing off 6-year mean. We're talking about a long-term average coming into play. So yes, some sort of reversal is expected in Asian Paints also.
All right. Thank you, Pritesh, for joining in and giving us all those details. With that, we'll simply do a short break, come back. We get you what the street is expecting from Wipro ahead of their fourth quarter earnings, which is due today.
Go back to 1989, which is when you actually started your project, your passion, which was how do you take Priya and make it a modern cinema-going experience for the Indian consumer. Same time as the iconic Amir Khan movie Qayamat Se Qayamat Tak, which was set to capture the imagination of the Indian moviegoer. Was Papa Kehte Hain the anthem playing in your head at that point in time?
Well, Papa Kehte to the in my case as well. But I was really never thinking of the Indian consumer or the macro economics of the business or the vast potential. Simply speaking, I just want to prove to my father that I'm not a failure.
We're starting at a new financial year. Is there a silver lining that you can spot?
Sid Field is one of the writers I read a lot. So he used to always say, in every story in life, or there's Act 1, Act 2 and Act 3.
Where
Act
are we today?
Act 1 is a setup. Act 2 is a conflict. And Act 3 is a resolution. My Act 2 has become very long.
Do you believe that there are likely to be regulatory headwinds?
Regulation should not happen at all. It is not part of an Essential Commodity Act. We don't come into that. So every time there is something that we hear from any state government, that's the only thing that saves us.
Welcome back. Well, let's focus on a couple of stocks then that are moving around in today's trading session. IREDA, that's surging after reporting a strong set of numbers in the fourth quarter. Abhishek joins in to break it down for us. Abhishek?
Well, strong sequential growth seen in IREDA, and it looks like the yield has been a positive factor as well. That has worked well for them with respect to spreads improving on a sequential basis. So disbursements are up 73.5% sequentially. That's helped the AUM growth to be around 28% YOY and 10.5% sequentially. While AUM growth is at 10.5% sequentially, the interest income is up more than 12% quarter on quarter, which looks like the yield has improved massively for them. So the NII growth is at 57.3% YOY and about 21.7% sequentially. Provisions are up 24.5% quarter on quarter, and PAT is up almost 49% YOY and about 18% on a quarter on quarter basis. So the spreads have improved for them. 2.42% spread at the end of FY25 when compared to 2.16% on a year-on-year basis and about 2.28% in the previous quarter, that is Q3 FY25. Their asset quality has also seen improvement. Gross NPA ratio is down to 2.45% when compared to nearly 2.7% in the previous quarter. Back to you.
All right. Thanks a lot for that, Abhishek. Let's talk about the earnings to track today. IT giant Wipro set to report its fourth quarter numbers. Reema joins in with the key expectations. Reema.
Well, expect a subdued quarter. Even in the case of TCS, if you remember, the company reported a sequential decline in their top line. They cited macro uncertainty, which impacted them to some extent in Q4. Some projects tactically were put on hold. Decision-making has been delayed on account of this entire uncertainty. So even for Wipro, anyway, Q4 is a seasonally weak quarter. So we're working with a revenue decline of about 0.5% in dollar revenue. Constant currency revenue growth should also decline on a quarter-on-quarter basis by 0.2%, but within the company's guided band of -1% to +1%. EBIT margins could decline on account of negative operating leverage, which is basically your revenue is declining and your costs remain the same. So EBIT margins could come in at 17.1%. But all eyes will be on what the company guides for the next quarter. That's the June quarter. Question number one is, does the company guide? Do they have enough visibility to give a quarterly guidance? Perhaps they do. But, what will the guidance be? The analyst reports mostly came out before, the tariff uncertainty was ratcheted up by a lot of back and forth. So the estimates that I have are -1% to +1%. Some believed it could be -1.5% to +0.5%. But, in the subsequent days post the analysts' note, the street has gotten a lot more cautious. And therefore, there is a possibility that the company would be conservative when they come out with the June quarter guidance. Also, bear in mind that Wipro has a higher exposure to discretionary demand. They had made that acquisition of Capco, which is a consulting company in Europe. So they're more indexed to discretionary spending, which gets compressed in times of uncertainty. So what the street says about that will also be watched. But again, as I said, the key is not the Q4 numbers, but if and what the company guides for Q1.
Take that point, Reema. Thanks a lot for that. We'll keep an eye out on the guidance out there for Wipro, along with all the other IT pack as well. But more importantly, just keep an eye out on a couple of stocks before we skip into that short break. Emcure Pharma is the one that really stands out. It's up around 7.5%. What's important about today's move is that it's crossed past that 1,008 mark on the share price. Emcure Pharma currently trading at 1,027. 1,008 was the price at which the company, gave shares at the IPO. After that, the stock actually went up all the way up to 1,400 thereabouts. So a big decline. And from those levels, it has now seen a bit of a recovery back around that issue price itself. We're also seeing some traction in names like Bajaj Electricals. That's up around 5.5%. And a few of these stock market, names like IIFL Finance, 361 WAM, and Angel One have all, moved higher as well. So the capital market plays come up for you. IIFL Finance is higher. We have 361 WAM. That's the one that should come up for you as well. It was in the red for most part of the day. Nimesh had spoken about a possibility of a deal out there. And Angel One, ahead of its numbers, up around 1% at the high point. Take a short break, come back. On the other side, we focus on all things commodities. Manisha Gupta joins in with Feroz Aziz.
Welcome back, and joining us on the show now is Feroz Aziz. He's Deputy CEO at Anand Rathi. Well, Feroz, hi. I know it's unusual for you to be getting you on a commodity segment, but I had to gloat about the gold price rise. So with the kind of gains that we're looking at, with 25% of a run-up in this year, 28% of gains in the last year, would you say gold now seems to be soon becoming a mainstream rather than just a safe haven or a hedge? You are on mute, Feroz. We can't hear you.
So, of course, you've been a bull, Manisha, on gold. I can probably tell you are the Rakesh Jhunjhunwala of commodities. That's how you've been eternally a bull. Okay, that's a tagline in my mind, which I thought I'll read out. So coming back, is it been mainstream? So let me break this down with some data. If you look at, gold, first let's test the hypothesis whether it's good hedge for a moment, and then go to the second part: is it become more mainstream than the hedge itself? Now, if you look at a study of the last 8 years, where you see when Nifty moved down, Nifty actually moves from peak to trough about 15% each year. So if you look at 2017-18, Nifty went down from 28 January 18 to 23rd March 18, which was the peak to trough of that specific financial year of 10%. In the same period, gold gave a positive 3%. Now, if I go to the last year instance of 2023 to 24, Nifty peaked on 15 September 23, and we came to the trough in just a month, 26th October 23. It fell by about 6.6%. In the same period, again, gold gave a 3% positive return. So the point I'm trying to make is, in the last year, 8 years, every time Nifty moved from peak to trough, in the same period, if you check, gold was positive. So does it go through the litmus test of hypothesis saying gold is a great hedge? The answer is a big yes. Point one. Point two, with the returns you see, for the last 5 years, the gold has done about 17.44. Nifty has done about 18.78 from 2019. So I think it is still, the jury is out for mainstream, but it's certainly a great debt replacer, as I've always been exhibiting.
Oh, absolutely. Just coming more closer home, Feroz, and if you look at the last couple of years or 3 years, I mean, I understand you're putting a point through across on longer term to shorter term portfolios right now. But with the kind of space that we're in right now and what we've seen in the last couple of years, and perhaps if that is anything to tell you on how the next couple of years can be, would you say gold has earned its space within a portfolio?
Yes, 100%. There's no two ways about it. But this quite a few gold participants have this myth that the trend of making money in gold, not for a trader, for anybody who has a 1 year, 2 year time frame as well, is not going to be dependent on how much a seasonal purchase is going to come. See, if you look at the gold purchases by governments and what kind of reserves do people have, the US is the highest with 8,133 tons. And then if you look at India, is 1/10 of that, 876. And last year we added 72. So if you look at the kind of additions last year, you saw Poland add 89.5 tons. So what will happen to the dollar gold will be determined by not household ownership, because household ownership globally is only 2.3, but in India, household ownership of gold as a percentage of the total household savings is 23. So I personally think, given the kind of uncertainty in terms of dollar, becoming a little more scarier reserve for a government to have, will definitely see their proportions change. And the dollar price of gold, I think I will be very buoyant in spite of this rally, which you just stated in 28 plus 25%. Dollar gold will be very buoyant given where Trump has taken the trade war to.
Clearly. Feroz, the other thing is, and a lot of conversation that I have with commodity players and institutions, etc., do tell us that the way the gold prices have been rising, the household very soon will not be able to afford it the way they have been doing it for many, many years. At $3,300 an ounce and at 95 lakh rupees a kg without the GST and the making charges, would you say there's more financialization and a more investment as a subject more related to gold now?
Yes, I personally think ornamental, but I think, see, if you look at incremental additions, most people in India are incrementally adding it, not from ornamental value. They just think that gold is a great asset to buy. Otherwise, what people can always do is the gold which Indian households own, 22.8% allocation to gold. That's not a small allocation. They can always recycle that. But will they be able to add coins and bars? I think so. In smaller quantums, in those 1-2 grams, I think people will be able to afford that. And the inclination is high. I was speaking to one of my closest friends who runs a chain of jewelry stores in Odisha. He says the sale comes down dramatically. My mark to market at my jewelry store of all my stock goes up, so I become very happy. But when I look at my sales numbers, they drop. So affordability definitely is a question, like you rightly pointed. But I think in the long run, if this is the price which continues, I think recycling of gold and smaller ticket investments. So investment will always have its merit. And I think people like the tangibility in India, how much ever you say. When I gifted 1 crore of ETF, gold ETF to my sister, she was there in November last year wanting to sell it. But she never sold physical gold. So I told her what that was. So that was surprising. So I think people love the tangibility, and that's not going anywhere.
Oh, absolutely. Feroz, almost everybody on street has a view on gold prices right now. What is your sense on where are we going for this year, next year? Have you done any calculations?
So if I look at calculations, what I can always I try to bet on is where it will not go. If downsides are protected and upsides are greater than debt, then I think that's a serious asset class I'll look at. So I personally think both these are very well taken care of in gold at this stage. So if my downsides are limited, after a rally, the biggest risk is, am I getting into something which has missed the bus and I'll only be a party to the downside? So I think downsides are going to be limited, point one. And will I get double-digit return in gold? I think on a 3-year holding period, I still believe at these prices possible.
All right, 3-year double-digit returns are possible. Feroz, this is Mangalam here. With me is Nigel in the studio as well. Manisha is there as well. Great conversation as always. Just 2 questions that we have. Since you're in, a tagline-giving mood, Manisha is the Rakesh Jhunjhunwala of commodities. Would you like to give a tagline to both of us as well? And secondly, we just briefly
Jealous, are you guys?
No, we just briefly heard him. Now is the jealousy part that comes in. Heard him speak about gifting 1 crore worth gold ETFs.
I couldn't get...
what is the procedure to be your sister, Feroz?
Maybe I qualify for that, not you guys, unless...
Yeah, which is why, okay. Go ahead, Feroz.
Coming to the tagline, I think I will call you the duo who pulls the opposite gender to watch TV. You guys are the best looking men on TV, and that's where you're getting a lot of female attention on television. So coming back on a serious note, so I personally think that, of course, gold as an asset class, Manisha, over the years have been propagating. I personally think gold is a serious asset class because Indians love debt as well. And debt is a short recipe to disaster. It's as good as kill slowly. It's like smoking of investing, debt. For long-term money. I'm not speaking of short-term money. Like we manage intergenerational wealth of clients. We don't even take clients who say, I have got 5-year money. We say we're not interested. We're looking at intergenerational wealth. In that, people having 50-60% in debt is cancerous to my mind.
Okay, all right. Thanks a lot for that, Feroz, as well as Manisha. By the way, we need to address some flashes that are at the bottom of your screen. It appears there's a bit of a hit that's come in, both for Lupin as well as Zydus. So explains why you pull up the intraday chart. Both those two stocks have moved to the low point of the day. We'll wrap up on this edition of Halftime Report, but Vinny is waiting for you on the other side on Business Lunch. She'll address that pharma news as well. Don't go anywhere.